You've probably heard that private credit has become one of the biggest stories in finance. A market that was once a relatively obscure corner of Wall Street has exploded into a machine measured in trillions of dollars. And the obvious story is pretty simple. Companies need money. Banks don't always want to lend it. So private credit funds step in, lend directly to companies, collect interest, and pass those returns back to investors. Sounds straightforward. But there's a problem. The most interesting part of private credit isn't actually the trillion-dollar number, it's what sits behind that number. Because when you follow the money far enough, you discover that the people lending money may also be borrowing money, and the institutions financing those lenders may be connected to banks, insurers, pension funds, asset managers, and individual investors. So the real story isn't simply about $1 trillion being lent to companies. It's about an increasingly complicated financial machine built on the assumption that borrowers will keep paying, assets will remain valuable, financing will remain available, and investors won't all demand liquidity at exactly the wrong moment. And that's where this gets interesting. The Federal Reserve reported that private credit loans reached roughly $1.4 trillion in the second half of 2025, equivalent to around 10% of U.S. non-financial corporate debt and roughly one-third of below-investment-grade corporate debt outside bank loans. The Financial Stability Board has estimated the broader global private credit market at roughly $1.5 trillion to $2 trillion. Those numbers are already enormous. But here's the question nobody should stop asking at the headline: who is financing the people doing the financing? Because that's where the machine gets much bigger. Let's go back to the beginning. For decades, if a company needed a large loan, the traditional answer was simple: go to a bank. The bank would examine the company's finances, assess the risk, make the loan, and hold that loan on its balance sheet. But after the financial crisis of 2008, banks faced much tighter capital and regulatory requirements. That didn't eliminate the demand for corporate debt. Companies still needed money. Private equity firms still wanted to buy companies. Businesses still needed to expand, refinance, acquire competitors, and fund operations. So another part of the financial system stepped forward: private credit. Instead of going to a traditional bank, a company could negotiate directly with a private credit fund. The fund raises money from investors, then it lends that money to companies. The companies pay interest, the fund collects that interest, and investors receive the returns. Everybody has a reason to participate. The company gets financing, the investor gets yield, the private credit manager collects fees, and the financial system gets another source of corporate funding. Then interest rates rose, and suddenly floating rate private loans became even more attractive to lenders. More money flowed into the sector, the market expanded, and eventually private credit stopped looking like a niche investment strategy. It started looking like another major part of the global financial system. Morgan Stanley estimates the U.S. direct lending market alone at around $1 trillion. And increasingly, access isn't limited to giant institutions. Semi-liquid investment vehicles have opened parts of the private credit market to individual investors. That changes something important. The money going into private credit is no longer coming from only a handful of sophisticated institutions. More investors are becoming connected to the machine. But here's where things get weird. Imagine a company called Acme. Acme needs $500 million. A private credit fund lends it the money. Acme pays interest every quarter. That interest becomes income for the fund. The fund passes returns toward its investors. Simple, except the private credit fund might also need financing. Maybe it wants cash before an investment is sold. Maybe it wants to finance a new transaction. Maybe it has valuable assets but doesn't want to sell them. Maybe investors have committed capital that hasn't actually been called yet. So the fund borrows, and now we have something very interesting. A lender is borrowing money so it can continue operating as a lender. This is known as fund finance, and it has become enormous. In 2026, Reuters reported that the fund finance market had surpassed $1 trillion, citing Moody's. Think about what that means. You can have a company borrowing from a private credit fund. That private credit fund can have financing connected to it, and the institutions providing that financing can themselves be connected to the broader banking system. So the debt doesn't just exist in one place, it exists in layers. Company owes fund has financing. Bank or another institution provides financing. Investors provide capital. Insurers and pension funds may own private assets, and increasingly, individual investors can gain exposure through investment vehicles. It's a financial lasagna, and unfortunately, nobody gets to eat it. Now, none of this automatically means something is wrong. Leverage isn't automatically a crisis. Borrowing can be productive. A company can borrow money, invest it, grow revenue, repay the debt, and make everyone better off. The problem appears when the assumptions underneath the structure start changing, and one of the biggest assumptions is asset value. Here's why that matters. Publicly traded bonds and stocks have a price you can see constantly. Private loans are different. Many don't trade every second on a public exchange. Their valuations can rely on models, company performance, comparable transactions, and assessments by managers. That means the market can sometimes look calmer than public markets. If a stock falls 30%, you see the price immediately. With a private loan, you don't necessarily get a giant flashing number every second telling you what the market thinks it's worth. That doesn't mean the economic value hasn't changed. It means the adjustment can happen differently. And this creates another important issue: liquidity. Imagine you own a house worth $500,000, but someone tells you you can only sell a small percentage of it this month. The house may still be worth $500,000, but if you suddenly need $100,000 tomorrow, the theoretical value doesn't solve your problem. You need liquidity. Private credit funds face a version of this problem. The underlying loans can be valuable, but they aren't necessarily assets you can sell instantly at yesterday's price, and this becomes especially important when investors want their money back. The Federal Reserve reported that some private credit vehicles experienced increased redemption requests during the first quarter of 2026. Several managers responded by limiting redemptions to around 5% of net asset value. The Fed described outflows as manageable. That's important. This was not a repeat of 2008. There was no evidence that the entire private credit system suddenly collapsed. But the episode revealed something. The system has to manage a mismatch between liquid investor expectations and relatively illiquid underlying assets. And that mismatch is one of the oldest problems in finance. Now add another layer. Private credit borrowers have to actually make their payments. Remember Acme? Acme borrowed $500 million. If interest rates are high, its interest bill rises. If revenue falls, the burden gets heavier. If the company can't refinance when the loan matures, the problem gets bigger. And if several companies experience the same problem at the same time, lenders have to deal with rising defaults. This is where the cycle can change direction. At first, higher interest rates can be great for lenders. They collect more interest. Investors like the yield. Capital flows into the sector. Funds raise more money. More loans get made. But eventually, those higher rates become someone else's expense, the borrower. And if the borrower is already highly leveraged, the difference between a healthy business and a stressed business can become surprisingly small. That's why the real risk isn't simply, will private credit default? The more important question is, how does stress move through the system if defaults rise? Imagine one company misses payments. The lender takes a loss. Not great, but manageable. Now imagine several borrowers have trouble at the same time. The fund's returns fall. Investors become nervous. Redemption requests increase. The fund needs liquidity. It may become harder to sell assets. Lenders become more cautious. New financing becomes more expensive. Companies trying to refinance old debt discover that the money isn't as cheap or as available as it used to be. And now you have a feedback loop. Higher financing costs create more stress. More stress creates more caution. More caution makes refinancing harder. And harder refinancing creates even more stress. That's how financial problems spread. Not because one loan suddenly destroys the world, but because the same assumption is being tested across thousands of balance sheets at once. And there is another reason to pay attention. Private credit has become increasingly connected to other parts of finance. Banks provide financing. Insurers and pension funds invest in private assets. Asset managers create vehicles for investors. Private equity firms own companies that borrow. And those companies may depend on private credit lenders for refinancing. So when you look at the system from far enough away, you don't see isolated loans anymore. You see a network, and networks behave differently from individual transactions. One weak borrower might not matter. One stressed fund might not matter. One bank reducing lending might not matter. But when multiple pieces react to the same shock at the same time, the system can become much more sensitive. This is why the comparison with 2008 needs to be handled carefully. Private credit is not simply another subprime mortgage market. The structure is different. The assets are different. The investors are different. The regulatory framework is different. So saying private credit is the next 2008 would be lazy analysis, but the mechanism is worth remembering. In 2008, one of the major lessons was that people underestimated the connections between apparently separate pieces of finance. The problem wasn't just mortgages. It was leverage, securitization, funding, liquidity, counterparties, and confidence. Private credit has a different structure, but it has its own network of connections, and that network is growing. Now think about what happens if the economy slows while financing costs remain elevated. Companies that looked perfectly healthy when money was cheap may suddenly have less room to maneuver. A company doesn't need to go bankrupt tomorrow for its debt to become a problem. It just needs to face a refinancing wall at the wrong time. Maybe the business still makes money. Maybe the underlying assets are still valuable. But if the company needs to refinance $300 million and the new financing costs twice as much, the economics change. And if enough companies reach that point simultaneously, lenders have a decision to make. Do they extend the loan? Do they restructure it? Do they take a loss? Do they demand additional collateral? Do they provide more financing? Every choice has consequences, and this is why the $1 trillion number is somewhat misleading. It sounds like a single mountain of money. It's not. It's a web of loans, funds, investors, financing arrangements, guarantees, collateral, and expectations. And the real bet is not simply that borrowers will repay. The real bet is that the entire chain will continue functioning smoothly. Borrowers keep generating cash, funds keep collecting interest, assets keep their value, investors remain patient, refinancing remains available, lenders remain willing to provide liquidity, and nobody suddenly needs everyone else to produce cash at exactly the same moment. That's a much bigger bet. And here's the part that should change how you look at the headline. You might see $1 trillion of private credit and think, that's a huge amount of corporate debt. But that's only the visible layer. Behind the loan can be a fund. Behind the fund can be financing. Behind the financing can be a bank. Behind the investor can be a pension fund, insurer, institution, or individual saver. And behind all of them is the same basic assumption: the machine keeps working. That's why the most important number isn't necessarily the amount of private credit outstanding. It's the amount of confidence supporting it. Because when confidence is high, leverage looks efficient, liquidity looks abundant, private assets look stable, and complicated financing structures look perfectly reasonable. But when confidence disappears, everyone suddenly starts asking the same question: how much is this actually worth? And that's when a quiet financial market can become very loud. So the next time you hear that private credit has reached another trillion-dollar milestone, don't just ask how much money has been lent. Ask who funded the lender. Ask what happens when borrowers need to refinance. Ask how quickly the underlying assets can actually be sold. Ask who provides liquidity when investors want out. And ask how many different balance sheets are depending on the same borrowers continuing to pay. Because the headline may be about $1 trillion, but the real story is the machine underneath it. And that machine doesn't need every loan to fail. It only needs enough assumptions to change at the same time. That's the hidden bet sitting in plain sight.